Hi everyone. So we were discussing question number 8 onwards. We have discussed question number 8. We are going to start question number 9 onwards. So question number 9 is about the negative enterprise value. Okay, so we have previously discussed about the consolidation and the minority interest. So we are discussing the enterprise value formula, and we are going in detail of the enterprise value formula. We have as of now discussed major portion of that. Out of 10 questions, 2 questions are left. And then we are going to discuss the enterprise value formula, which is actually applicable in the real world. So the thing is that there is a difference between what we do in theory and what we do in practice. So we will do a real world enterprise value formula also. We'll discuss about that. Okay, so let's get started with question number 9. So question number 9 is about the negative enterprise value. And can enterprise value be negative? Okay. If we understand the formula for enterprise value one more time, so enterprise value is equal to market cap. We add back the debt, we add back the preferred equity, we add back the minority interest, and we subtract cash. So a company has they have actually reported these numbers. So and market cap is 150, debt is $10 million, and the cash reserve is 200 million dollars. So if we calculate this, we will get an enterprise value of negative $40 million. So could this be a case? And it's a very rare case, and investors actually expect declining future cash flows or liquidation in these kind of cases. But yes, this can happen. Previously, also when we discussed whether or not the enterprise value is always greater than the market cap, this could be true. And so negative enterprise value is also a concept which can come into picture. But the cause, like initially we were discussing, we actually have to understand what, why, and how. The questions. What is this indicating? What, why, and how? So what does this means? Negative enterprise value. So negative enterprise value, yes, if you look at the formula, the real life, what we have to add, what we have to subtract. So this is possible. This means there is a lot of cash in the company, and the only thing which we are subtracting here that has more weightage than what those things which we are adding in the question. So yes, what does this means? Yes, this means that cash is more. Why is this happening? And how do we calculate and how or what do we interpret out of this? So negative enterprise value usually means that the company actually has a very large cash reserve. Cash reserves are very large. Uh, the market cap value is very low. This means market cap is very low or very low valuation. This means the market is low valuation, that the market is valuing the company very low. The stock price has declined, maybe. Um so maybe there is a decline in the stock price. The stock price is declined. And this kind of situation, if we think about this second point, market cap is very low. So this means this actually is a very common thing to notice about companies which are in distress or the business is declining. This can happen in distress and declining. If you ever encounter a situation where the enterprise value is negative, then you will actually have to dig deep. By looking at how will you dig deep, you will look at the whether the company is distressed or it's a declining business. And if every of your checks, I mean, if you have seen, you have looked at the business from every angle, and if everything is good for the company, so this is actually, if there is nothing wrong with the company, so this is actually a great investment opportunity. If a company has a negative enterprise value and everything is running fine with the company, it's not a distressed company, or neither is the business declining, and you have answered, you have checked everything, all all the parameters, the company is good and sound. So this is actually and this is actually a great opportunity to invest, deep value opportunity. The enterprise value, yes. Then this is how uh, investors actually find the opportunities, investment opportunities. So they always look at the data, they always do the comparisons. And when they find out this kind of company, they will invest in these companies. And when you are understanding, you are learning about valuation, or if you are doing valuation, if you do not believe in your valuation, then who else will believe in your valuation? Okay, so let's understand. I hope this is clear and this makes perfect sense. Explain how a company have a negative enterprise value. This can be done. Uh, can the like, how can a company have a negative enterprise value? It might be that the company has very large cash reserves, or the market cap is very low. Maybe the investors are saying that they are not valuing the company properly. The market is not valuing the company properly. They do not have confidence in the company. But if everything is okay with the company, it's not a distressed company, and this kind of thing happens in a distress or a declining business company. But even if it's okay, after checking everything, if it's not a distress or a declining business, then this is actually a great invest opportunity. And what it implies to the investors, that this is a great or deep value opportunity. Okay, so we have discussed negative enterprise value in detail. Okay, now move to enterprise value. Okay, so previously I have told that these questions were in the sequence of easy to difficult, and this was actually one of the difficult question. And now the 10th question, which is also a part of the difficult questions. So enterprise value in valuation multiples. What does valuation multiples means? So valuation multiple is basically when we are valuing a company, we look at certain multiples. So enterprise value multiples are one of those. If okay, so let's go to the question and understand what the question is about. Two companies have identical EBITDA, but company A has more debt and less cash than company B. So debt is more and cash is less. And for company A has more debt and less cash than company B. And company B has less debt and more cash. So explain how does this affects the enterprise value. So enterprise value will increase with the debt. Actually, enterprise value is basically how much you have to pay if you are going to acquire a business. So if there is more debt in the company, then you will actually have to pay more. and you have less cash on your side to pay off the debt. But if you have less debt and more cash, in this case, enterprise value will also fall. So in this case, enterprise value will be low. So you actually have less debt and more cash, and this cash will be helpful for the investors. So enterprise value should be high or low. Understand this from a perspective. No, this okay. Always a high enterprise value doesn't mean it's a good thing. Enterprise value could be low. So from an investor's perspective, and you are going to buy something. So if you are buying something in cheap at a cheaper price, it's beneficial for investor only, not for the seller. And here, the investor who are acquiring the company, they will actually have to pay more. So because of the debt component. So enterprise value, here the enterprise value will be high, and here the enterprise value will be low. If here enterprise value is high and enterprise value here is low, what it would affect, what effects would it have on the enterprise value to EBITDA ratios? And simply enterprise value to EBITDA ratios, okay, let's understand this from a numerical perspective. If enterprise value is 100, and here in this case, the enterprise value, which is low, I'm assuming that is 50. What about if the EBITDA? EBITDA for both the companies is $20, $20 million. So in this case, the enterprise value will be high. Enterprise value to EBITDA ratio will be high. In this case, enterprise value to EBITDA ratio will be an interpretation of of a comparison in merger and acquisition or equity research. It, it, company A is riskier, higher EBITDA to is that is pretty higher risk. It, it has higher acquisition cost. Company B it may look cheap and has healthier capital structure. Independent of the acquisition or equity research. Okay, so now let's move to the another part of this episode where we will discuss about the enterprise value formula in the real world scenario. So in the real world scenario, enterprise value formula is different than what we have just discussed. So there are other components also in the enterprise value formula. We have discussed about the equity value, market capitalization. We have discussed about the total debt. We have discussed about the preferred equity. We have discussed about the minority interest. And we have discussed about the cash and cash equivalent. But in practice, there are other components also which are included in the real world enterprise value formula. And I wanted to do a separate episode for this thing. But since we are discussing it, we have time. So let's discuss it right now. Okay. So enterprise value, if you look at this, in real world, the enterprise value is way different. The calculation of enterprise value is way different. And enterprise value basically is available to all capital providers, whether it's debt holders or equity holders. Real economic value of the business is actually the real economic value of the business is the enterprise value. Uh, Equity value, we have discussed that this is the share price and we multiply it with the fully diluted shares. And dilution means that stock options, RSUs, restricted stock options, and convertible debt securities. Convertible, it could be stocks or it could be bonds. So convertible stocks or convertible debts, which actually have a future claim on the stocks. These are the fully diluted number of these actually these are considered when we are calculating the market cap of the company. Fully diluted number of shares. Actually, we actually have to look into the we actually have to look the impact these are going to create on the company's basic stocks. That's why they are called as diluted share, dilutive securities, dilutive in nature. Then we have discussed about the debt. So short term and the long term. And short term debt is actually less than 1 year. The short term debt is actually something which has a life of less than 1 year. So we are not going to carry forward it into the future. We will try to we will try to adjust it as soon as possible. So we have discussed about this thing, short-term debt and long-term debt. Preferred equity also behaves like debt only because there is dividend and there is a claim in dilution of business or bankruptcy, just like debt holders. Minority interest we have discussed. If it's more than 50%, but less than 100%. So companies actually, parent companies consolidate them into their financials. We have talked about cash and cash equivalent, but now we need to understand what is capitalized lease liabilities, debt like liabilities, capitalized lease liabilities, convertible debt, marketable securities, short-term investments. This is sector specific. Long-term debt, non-operating investments. This is also sector specific. Unfunded and non-operating assets like excess of real estate investment portfolios and other adjustments also like foreign exchange hedges, which is usually considered in energy and oil and gases. This is actually, these things are actually sector specific, restricted cash and our. Okay, so let's get started. We have discussed about market cap. This is the formula here. And fully diluted shares, employee stock options, RSUs, PSUs, uh, convertible securities, in the money, out of the money. One more thing, since we are talking about it, okay, preferred equity. When we are calculating the EPS, if we have uh, earning per share, if we have preferred equity or any security which is paying dividend, so we also need to adjust the net income. So net income's formula is net income. So EPS formula and earning per share formula actually include dividend paid to the uh, preferred stockholders. And then the fully diluted shares. If stocks are diluting, so we actually also have to adjust the net income, because out of net income we are paying to the dividend. We are paying dividends to the holders. And when we are talking about convertible securities, there are convertible securities also where, or convertible debt also where dividend is paid to the stockholder, to the holders of those securities. So this is a whole new other episode. We will discuss about this in detail, and we will also do questions so that we get a better understanding of what we are discussing. So just I wanted to share this thing, and this is out of the context only. So, okay, so let's move. Okay, we have discussed about minority interest. Yes, we have discussed about that. 50% more, if a company owns more than 50% of subsidiary, it consolidates 100% of the subsidiary revenue into the EBITDA to match the enterprise value with the EBITDA. So that's why minority interest is added. Why minority interest is added? Because of this thing. Market cap, how it's calculated using this, and fully diluted number of shares. Uh, these are the securities which actually influence our fully diluted number of shares. Debt, we have subtract. We actually do subtract the short-term debt using the cash. And that's why in most of the cases, you will see net debt, basically, net portion of the debt. So they have netted the debt. So what they have done is they have the long-term debt, long debt. They have subtracted the short-term debt from cash. They have subtracted the short-term debt using cash, because the life of the short-term debt is less than 1 year, so it doesn't make sense to carry it forward. Uh, okay, so preferred equity we have discussed, must be repaid, has required dividends, so we added it to the enterprise value. Let's discuss about capital leases. So capital leases, for that we will discuss about IFRS 16 and ASC 482. So these leases are also treated like debt. So if it's a whether it's a financing lease and it's an operating lease. So difference between a finance lease and operating lease, uh, I mean, it's very difficult to give you just a hint, but see, finance leases have a life of, so we actually have to renew them every now and then. But operating leases, we capitalize them because these are long-term leases. Long-term leases. And just like short-term debt, we try to adjust the financing lease liabilities. We expense them out usually in the income statement, but the long-term leases are actually capitalized on the balance sheet. So these are balance sheet items. So we actually have to treat the leases as, okay, like debt only. So capital leases and lease liabilities, we treat them as debt under IFRS 16 and accounting standard codification IFRS 16 and accounting standard codification 842. Let's not go into detail of these things. We will, okay, I will do a detailed video of IFRS 16 and ASC 482 along with the other things we have discussed about. Okay, so we need to consider the capital leases portion of the company also. And after that, other debt like, okay, before that, let's understand what else is there. Convertible debt or preferred, convertible debt or preferred debt. This also we have to consider. Uh, if there is convertible debt or convertible preferred equity, so we need to consider if it's in the money, we count it as equity, and uh, and if it's out of the money, we treat it like debt. This means, okay, what is in the money and out of the money? I'm just giving you a small recap here. So, like, understand this thing. I have given you a contract that you can say that uh, you have 10 bonds, and you can exercise these bonds if the stock price is $5, and in the money or out of the money. If the company stock is running at $2 in the market, or if the company stock is running at $7 in the market, if it's running at $2 in the market, this doesn't make sense to exercise this thing. So you will not exercise this thing. Why? Because you can buy this stock from this you can buy the bond, or you can exercise the bond and convert these 10 stocks, 10 securities into equity stocks. So you will convert them into stocks, but this doesn't make sense to the for the investor, because what's the whole point? You will pay $5 for something which is already trading for $2 in the market. This is available for $2 in the market. So why will you pay $5 to the company? But if the stock is at $7, trading at $7, so this is what the in the money means. So this is actually beneficial. So this means that you will pay company $5. Company will give you an option to pay $5 for 10 stocks, and then you can do what? You can have 10 stocks, and you can sell these stocks for $7 in the market, and then in this case, you will gain $2 per stock. So this is the concept of in the money and out of the money. If it's in the money, it will be counted as equity. This means that we are considering that you will exercise the option. But if it's out of the money, then we are going to treat it as debt, and we are going to give you a dividend. So if it's out of the money, we are going to treat it as debt, and we need to adjust our net income when we are calculating the earning per share. And if it's out of the money, if it's in the money, we are going to treat it as equity, and we are going to adjust our diluted number of shares. This is what it means. And after that, debt-like securities. We are discussing, we will discuss about debt-like securities first. So in real life valuation, there are more debt-like securities. Like there is pension fund, pension deficits are there, and there are deferred compensation and obligations. There are environmental and reclamation liabilities, legal settlement liabilities, asset retirement obligations, customer prepayment with no future cost saving. And you will find all these line items, all these listings in your balance sheet sometimes, or in the notes section. In the financial notes section, you will find these debt-like liabilities in your financial note liability, in your financials note section. And these are not accounting debt, but these are economic liabilities that reduce the value of the equity also. So that's why these need to be considered. And restricted cash, it depends on whether it's for operating or non-operating. If it's for operating, we include this in the enterprise value. But if it's non-operating, we subtract it from the enterprise value. This we have discussed. We are going to subtract the cash and cash equivalent. And the non-operating investments, these are basically subtracted. So these are the non-operating adjustments like marketable securities, trading portfolios, excess real estate, unconsolidated investments, equity method investment, joint ventures, non-core assets. So we subtract these because these measure operating enterprise value only, not the whole enterprise value. And these are liquid in nature also. So we need to subtract these. So we are not going to pay for these when we are calculating the enterprise value because these are useless and operating enterprise value to measure. We are calculating the operating enterprise value. So and after that, these in real life formula, in real life calculations, we actually subtract these things. And okay, let me just see what else is left there. Okay. So in the end, we adjust for these. We adjust for professional valuations uh, to adjust for foreign exchange hedging assets and liabilities. Foreign exchange hedging, and the word hedging means that I am trying to, using financial instruments, I am trying to, hedging is kind of an insurance. So I'm trying to insure my losses. And foreign exchange hedging, the losses which will be caused by foreign exchange. So I'm going to hedge the foreign exchange hedging of assets and liabilities, and these numbers are basically given in the notes or in the uh, other comprehensive income component of the balance sheet or income statement. Derivative positions. So financial hedging is actually done using derivative positions. Earnouts and contingent considerations. So earnouts and contingent considerations, we need to adjust for that. Earnouts and contingent consideration, these are usually done in merger and acquisition or LBO. Okay, not merger, not LBO, but majorly you will hear about these things when you're interviewing yourself for merger and acquisition, for a merger and acquisition role in vertical of merger and acquisition. So earnout and contingent consideration is somewhat around, these are kind of conditions. If the company performs to a certain level, or in the next few years, if the company can generate this much of revenue, deal the deal pricing gets, I mean, the buyer pays extra to the seller. So in at only if some conditions are met. So earnouts and contingent consideration are related to that, and we need to adjust for deferred tax assets. If those are non-operating, and excess working capital, we need to adjust for that also. Minority interest in joint ventures, not in subsidiaries, but in joint ventures. That's a different thing. Preferred dividend in arrears. Preferred dividend in arrears if we have not paid somebody. So we actually have to adjust for preferred dividends in arrears also. So we were supposed to pay, let's assume $10 million, but we have not paid $10 million, and we have deferred those $10 million. So we need to pay those in arrears also. So we need to adjust. We need to look at the detailed company financials. Then we actually have to uh, adjust our enterprise value, and that's how we actually calculate the real enterprise value in real world. Enterprise value in real world. So this is the final formula, and enterprise value in real world is actually the equity value. We add the equity value. We add the equity value. We add the short-term debt because this is a part of debt. Long-term debt also. If we subtract if we subtract the short-term debt and we pay it out from the cash, and we can also see net debt or netted debt net. These kind of always look For this is just basically we have adjusted for net debt, short-term debt. Preferred equity. I hope it's clear now. Minority interest, we have discussed in detail these things. Capitalized leased. This is where IFRS and ASC accounting standard codifications come into play. Pension deficits. Another important thing which we need to consider as a liability. Environmental, legal, and ARO liabilities, we add it out. Out of the money convertibles, we add them. Or if it's in the money, then if it's in the money, this will impact our diluted number of shares. But if it's out of the money, it is treated as debt. This is why we add it back. Out of the money debt. This is considered as debt. And contingent considerations earnouts, these are also considered as debt. And these are uh, based on performance, basically, based on how the company performs. So if the company performs better, then we have to pay them. So that's why it's considered more of debt. But if the company fails to perform, then we will do the adjustments, and we will use. Uh, this is actually something which is favorable for the acquirer. So cash we will use to pay off marketable securities which are which have somewhat around similar nature to cash and cash equivalent. Non-operating investments, we are not going to, because operational investments only. Why non-operational investments? Because there is no use of having non-operational investment, because to generate revenue, these investments are, I mean, not useful. So that's why they are categorized under non-operating investments. So that's why these are useless to the acquirer. Companies include them because of some reasons. Let's not digress from the topic. And excess real estate, this is also not helpful to the acquirer. So this is excess. Ec- Equity method investments, if non-operating, if they are operating, we are going to keep them. Always look at non-operating. So whatsoever is non-operating, we are going to subtract that. And the foreign exchange derivatives and miscellaneous adjustments. So foreign exchange hedges, derivatives. These depends on the industry or the sector. And the miscellaneous adjustments, a lot of other miscellaneous adjustments. Earnouts, okay, deferred tax assets, excess working capital, minority interest in joint ventures, preferred equity, preferred dividends in arrears. So these kind of adjustments. So this is the enterprise value.